Hey everybody, my name's Teg and I'll be going over the key concepts and lessons in Chapter 5, Merchandising Operations. The key concepts and lessons include 1, the difference between merchandising and service companies, 2, the 2 key inventory systems which are perpetual and periodic, 3, FOB shipping point versus FOB destination, 4, purchase returns and allowances and sales returns and allowances, and 5, single-step income statements versus multi-step income statements. So what are the differences between a merchandising and service company? Well, a merchandising company is a company that buys goods and resells them for a profit, whereas a service company is a company that generates income by providing their customer with the service. Now there's 2 key inventory systems, the perpetual and the periodic inventory system. The perpetual inventory system is constantly updated as goods are bought and sold, and is done on a unit by unit basis, whereas the periodic system updates your inventory account periodically at regular intervals, and it's usually done by a physical inventory account that employees do. Now I'll be going over FOB shipping point versus FOB destination. FOB shipping point is when the buyer incurs all freight costs and owns the good the moment the good is shipped out towards them. And FOB destination is the opposite, where the seller pays the freight and the ownership is transferred from the seller to the buyer the moment the goods arrive at the buyer's door. Next, I'll be going over purchase returns and allowances and sales returns and allowances. So, what's a purchase? What's a sale? A sale is an exchange of a good or service in return for money. A sales return is when the buyer of a good returns a good to the seller and the seller gets back their inventory and the buyer gets back their money. Whereas a sales allowance is when the buyer keeps the good that they wish to return in exchange for a price reduction on the principal amount. Now there's sales discounts, which are broken into 2 different types of sales discounts. A purchase discount, which is a price break if something is bought on credit and is paid off early. So let's say you buy something, you have to pay it off in 10 days. You pay it off in 2, you get 30% off. Boom. That's what a purchase discount is. And a quantity discount is a price reduction that correlates to the volume of the purchase. So the more you buy, the less you pay. So what's a purchase then? Purchase is the acquisition of a good or service in exchange for money. A purchase return is when the buyer returns merchandise for a cash refund or a credit refund. And a purchase allowance is when the buyer keeps merchandise for a discounted price. Lastly, I'll be going over single-step versus multi-step income statements. A single-step income statement classifies data into 2 categories, revenues and expenses. And expenses group the non-operating expenses and operating expenses together to calculate your net income or loss. Whereas a multi-step income statement has multiple components that determine your net income and loss. And those components include 1, net sales, 2, cost of goods sold, 3, gross profit, 4, operating expenses, 5, income from operations, and 6, income before your income tax. And that concludes my Accounting 217 presentation.